Good morning. You're watching the market right here on ET now. And yesterday, what a market it turned out to be. After a quiet start, we finally picked up momentum and gathered it all the way well above that 18,250 level. So clearly the momentum has been sustaining. In fact, we've managed to close above that 18,200 print for the second time now and for the first time since January 3rd. Strong momentum over the past 3 weeks. This is not just these weeks strength alone. You've seen the HDFC twins, you've seen Reliance Industries, all of it contributing to the rally. And good to see that it's, pretty much across the board, Nikunj. It's not just a frontline-led rally, but even the broader markets are participating.
Shasha, if you frankly ask me, markets are moving as per the script. That's how it happens. When oversold market suddenly rediscovers momentum, it will see, it'll climb the wall of worry, then you will see liquidity support kicking in, short sellers will cover their positions, then the desire to trade long will come back, and then the FOMO effect. I think we are in that leg where the FOMO effect has just kicked in. And this time around, the FOMO actually is coming from, guess what? Foreign institutional investors. Hello, my friends. Foreign institutional investors have just been selling, and they've been selling Indian equities. They've been net sellers in 2022. They've not participated diligently in 2023, and now they've been forced to make a comeback. The setup is very simple to understand. Commodity prices have collapsed. US regional problems are creating a pressure on Wall Street. The world is certainly in a much better shape than it was, let's say, 3 to 6 months ago. And now the hunt for higher yield, something I think is obvious. Same time last year, everybody was migrating into safety of capital. Now everybody wants return on capital, and that's where I think the India advantage is there. So, forget the retail and the Johnny-come-lately crowd. I think this time around, the FOMO club belongs to our fair weather friends, foreign institutional investors. So I think you want to say hello to them and say welcome back. And I think the numbers are pretty much telling you that they're desperate to come back and reinvest in India.
Yeah, absolutely.
Oh, well, yes, and the earnings season so far has also been quite supportive, right? Apart from the howler that came from Infosys and other IT companies, if you look at the other sectors, whether financials and auto for that matter, has been fairly impressive.
See, what drives the market in the short term? Sentiment. The sentiment has changed. Then it's liquidity, and then it's earnings. Liquidity has turned, sentiment has changed, and earnings are supportive. So it's that purple patch for the market. I've been maintaining this view, and I would like to insist that don't sell in the month of May and go away. The best part of the rally, I think, is not behind us. I think now the FOMO crowd has just about kicked in. Markets, they follow a pattern. There is nothing different. For an oversold market, it will move to a market where you will see a bit of an excitement and a bit of a euphoria, but the FOMO crowd has just about kicked in. So the best gains in some individual stocks, I think, are yet to be captured.
Well, yeah, and today as well is an earnings-heavy day. You've got Britannia reporting its numbers amidst the Nifty earnings, and then, of course, you've got Marico, you've got Federal Bank, you've got Paytm. I think many in the market would be looking out for the commentary from this one, Piramal Enterprises, as well as Bharat Forge too. But yes, just looking at the texture of the markets, and I think, one important factor is also the cool-off that we've seen in commodities as an asset class, and of course, keeping gold and precious metals aside, but crude more importantly. It's $10 per barrel, which has been the average price of Indian crude basket.
Yeah, so crude down, not good news, but great news. But steel down, not such good news. So in totality, you have to really look at it, that if commodity prices they remain where they are now, crude you will benefit. But if metal prices they come down, if other commodity prices they come down, it surely will have impact on the earnings of a Tata Steel or a JSW Steel, or for that matter Vedanta. Net, you may actually see the sectoral orientation of the market changing. Net, every time crude prices have gone down, it has benefited the market's Indian economy a lot more than the decline in other metal prices. So what you may actually see is a turn which I think is visible, and that explains that why commodity consumers are suddenly outperforming. So you actually will see a decisive shift from commodity producers to commodity consumers, with the exception of 1 or 2 commodities, which is a special situation like sugar and a little bit of cotton because of the production issues there, crop issues, not production issues. I think commodity producers, the best of the gains, at least in the near term, that is behind us.
As that's showing up in the numbers, CEAT reported a 560 basis point expansion in the margins. Hero MotoCorp as well as TVS managed to show resilient, operational performance with the margins coming closer to 13% as well. But what are the other global commentary that you have to track this morning? Let's go across to my colleague Vinny. She's standing by to run us through the top highlights coming in from across the world. Hi, Vinny.
Good morning, and obviously just giving a precursor because before we start with all the global comments, what happened overnight was ECB has taken a rate hike of 25 basis point, and obviously in terms of the commentary that is coming from the ECB President Christine Lagarde, she's saying that hinted at more hikes to come as well. So most of the comments are surrounding that as well, and let's first start with Peter Schiff. Now what he's highlighting is while rising interest rates have pricked the Fed inflated credit bubble in 2008, causing the banks to fail. The media called it a financial crisis. Well, the same thing is actually happening in 2023 as well, only on a much bigger scale. So that is a factor that he's highlighting, and yet what he's highlighting is that media is actually refusing to call it a financial crisis, but he is saying that this is similar to what we saw in 2008. Moving on to Holger. Now what he's highlighting is that yes, ECB has taken that rate hike of 25 basis point, which was expected, and hinting towards more of a rate hike coming in. When you're seeing the main refi rate is also, as well as a depo rate, is both at a decade high. So that is a factor that he's keeping an eye out on, and he expects to stop the app reinvestment as of July. So that is something we should be focusing on as well. Now, in terms of just a note that is coming from BOFA, and this is on a India strategy note that we're seeing, where they are highlighting that earnings in India companies mostly have been could be slashed by nearly 40% in this fiscal year and next year also, due to a host of global and domestic risks that is panning out, and that could impact the Indian company earnings as well. And lastly, just in terms of what is a comment coming in from Mohammad El Arain, is that he sees this as another masterclass by President Christine Lagarde in terms of the rate hike coming in, where she's clear, confident, and enhancing the remarks delivered is very informative and informed fashion as well. So there is a decisiveness, and what we could be expecting from ECB is what he's highlighting.
All right, Vinny, thanks a lot for that. Now, I just want to bring out two stocks here. A tale of two auto companies, a tale of two-wheeler companies, two two-wheeler companies. Now, that's yesterday's change. Let's look at the one-year change. You will see a very big, dramatic shift in how TVS has moved. 85%. Hello. 85% is what the stock has registered in last 1 year. Hero MotoCorp has done nothing. Now, if you just look at the picture is very simple to understand. TVS Motor margins were decent. Their EV portfolio started, expanding. They made all the right investments. And Hero MotoCorp, on the other hand, their margins were under pressure. They lost market share. They don't have a formidable presence in exports, and they have not really taken a giant leap forward in the EV space. 2022 and 2023 so far has been all about this entire market's love affair with EV. Will that love affair continue? I think it will continue as a long-term story. But if you're an investor, if you're watching the show, I think it's time to flip and switch. TVS Motor, the numbers, and I'm bringing these stocks out because both these numbers came yesterday after the bell. Hero MotoCorp margin expansion. Hero MotoCorp has done nothing in terms of a stock performance. Yes, there are challenges. They are losing market share. But if you compare what is there on the table, I think TVS Motors, they're expanding, but their subsidiaries and incubation will take some time. Hero MotoCorp is recovering, and they're getting the mojo back. So I think it's time to switch from TVS Motors, which is expensive, versus Hero MotoCorp, which is cheap. And I will not be surprised that going forward, this really could be the trade of the year, where you want to sell TVS Motor and buy Hero MotoCorp for some of the factors I explained. TVS is expensive, Hero MotoCorp is cheap. EV business is something which markets are discounting in, and Hero MotoCorp is trying to come in EV, where something you may be in for surprise for next 1 year or 2 years.
Oh yeah, absolutely. And given that huge gap that both are trading at, and that TVS Motors in the last 1 year has actually scaled up almost 85 odd percent in trade in terms of a stock market performance in the last 52 weeks, and Hero MotoCorp has been a stark underperformer. That only makes the case stronger for that switch to happen. By the way, the SGX Nifty this morning, it's indicating a very, very flat start. I was just looking at the Asian screen there as well. You're not really seeing any fireworks. But who knows, maybe we could, call the trend as we did yesterday, given that we started off quiet and then picked up and managed to close at the session highs and were actually the world outperformers in terms of a market performance. So yeah, Shanghai, in fact, is the one which is actually seeing a fair amount of red. But let's see which way we head from here. Here's Ravi Dharamshi, though. We spoke with him just yesterday. He's making actually a case for financials to lead from here. Let's listen in.
Out of the $40 billion outflow that happened, $20 billion went out of financials. Now you just juxtapose it with the fact that US regional banking is facing a severe crisis. The larger banks are being called upon to support the smaller banks. And of course, yesterday Fed made a statement that, that was an exception. It's not likely to happen. But what that tells you is that elsewhere, there are problems created by the lending sector. While in India, it is the strongest sector. In fact, nobody talks about an asset quality deterioration or any of those things. All we keep discussing is, will there be an impact on the NIMs? Is the growth going to be high enough or no? And in fact, I find financials as the only place in the market where there is a combination of growth as well as value. Most of the places have growth, then the valuations are not in your favor. Or if the valuations are in your favor, then there is no growth on the horizon. So financials is the only place which has growth plus value and will be the first port of call for any foreign money that will be coming into India. And I think what will happen is maybe the second tier and the third tier rung in the financials will also start benefiting from this. So now we are witnessing probably some change of guard. We have already witnessed a change of guard in the large banks. Probably we are going to witness a change of guard in the large NBFCs as well. So some of the performing ones will probably get outpriced before they even come down.
All right, now let's talk technicals, and just before we do that, let me just establish the big picture here. The big picture here is that exactly a month ago, we were talking about breakdown. Now it's a clear breakout. 6 weeks ago, there were a record high in terms of short positions by FI in the F&O market. Now it's really the other side of the trade. So fear has become what could be called as an opportunity now. The typical way in which how markets have moved, and that's how FIs have been buying. I mean, isn't this FOMO? What is FOMO? This is FOMO. Told our foreign friends not to sell India. Don't beat down on the India story. Now they're coming back and buying at higher levels. Why did they sell earlier? That's FOMO, and that's how markets work. I mean, stock market is perhaps the only place where when prices go higher, demand comes back. When prices go lower, demand is not there. It should be the other way around, right? And now foreign institutional investors have been forced to buy into stocks which they ignored because they thought that inflation is going to be having a huge impact on India's balance sheet, and the forex reserve will dry up and crude prices will create an havoc and inflation is going to be in problem area. Now they've been forced to come back. It's very simple.
Yeah, absolutely. In fact, let's do the reading on the charts and figure out whether this strength is here to stay or not. And Kunal, Naresh, hi, morning. Consistent buying from FIIs. We're comfortably above 18,200. Kunal, what's next on the cards?
Yeah, so I think we can just expect the momentum to continue for the index. 18,450 could be a next target on the upside. But I think more importantly is the data when we read, across the F&O space for the indices. 2 days back when the markets were just heading or going into the Fed policy event, we I think entered into the event on a slight negative note for the indices, 0.5% or down or so for the indices. But there was no change in terms of the open interest. Very few decimal points of change in terms of the open interest for Nifty and the Bank Nifty. And yesterday when the markets showed good momentum, especially good comeback for Bank Nifty in the second half of the session yesterday, we saw almost a 7% jump in the open interest, which means when you try and look at the coherent data point, it indicates that traders are not looking to initiate short positions over here. even if the markets are going into a downward spree, they are going to a wait and watch mode. But when the markets are going to an upward spree, they are happy carrying long positions for the indices, both the Nifty as well as for the Bank Nifty. So I think that's an encouraging sign. Supports from 17,800 have risen higher to 18,000 levels for the index, and keeping that as a stop loss or as a support range, would look out for targets on the upside of 18,450.
Naresh, what's your sense on the market at this point of time? Bank Nifty is just 400, 500 points away from the all-time high levels. Is that coming soon, you believe?
So I would expect we could go towards those levels, but can we sustain beyond those in the extreme short term seems a little difficult, unless and until the HDFC Bank breakout plays out in a big way. So overall for the Bank Nifty, the crucial part going forward is we will be HDFC Bank sustaining about 1720 levels. The risk reward is not great at current levels given the fact that we are 400 points away. So Bank Nifty is something which we keep on a no trade, wait for a decline, or wait for some consolidation over here. Nifty continues to be a hold. The trend is still strong. We've crossed about that 18,200 mark, and crossing that in a jiffy indicates that the base should shift a little higher. So the earlier base for me was 17,800, and now I would expect 18,000 to be the base in the short term. And overall, if you look at the broader markets, the strength continues. We are seeing sectoral rotation, stock-specific price action. So the trend is still positive across the board. Till the time we don't see a change in trend, we should keep it simple and ride it on.
Right, okay, let's talk individual stocks. Yesterday was all about financials. What could it be today? Kunal, what's on your list?
So individual stocks, two names which I would be bullish on. One of them is ONGC. Apparently the stock gave a breakout 2 days back, had a mild correction. So going contra on ONGC, expecting the stock to pick up pace from where it left off yesterday. Targets of 166 on the upside, stop loss at 157. And the second is Grasim, because I think the stock is also heading towards a classical breakout, flag pattern breakout on the daily charts for Grasim, closing above that 1750 mark, which had been a hurdle point for at least the last 1 or 2 weeks for the stock. So suggesting a buy 1850 as a target for Grasim, stop loss at 1700.
Right, Naresh, what about your stock ideas?
So first is a buy on HDFC Bank. The stock gave a breakout into a new 52-week high and an all-time high, closed just around that 1725, 1730 mark. Now that's a price point which has been there for the last 4 times over the last 2 years. If this sustains, it could make a move towards 1900 to 2000. Keeping a strict stop loss at 1680 with a target price of 1900 in the short to medium term. Second is a buy on Apollo Hospitals, which has given a triangle breakout, sustaining about that 4500 mark. The stock is shaping up for a move towards 4900 plus. Also the fact that over the last 1 year, all the hospital names have done well. Apollo Hospital has a lot to catch up with. So looking at it as a short-term trade as well as could be a medium-term bet also from you.
Okay, interesting that you have HDFC Bank on your list. It's already at all-time high levels, but today there might be a bit of a negative sentiment there because remember, MSCI has put out a notice saying that they intend to add HDFC Bank to large cap segment of MSCI Global, but they're looking at the adjustment factor of 0.5 versus market expectations of 1. That means that the expectations of incremental inflows really gets out of the window. So that might be something that might work for HDFC Bank today. A bit of a sentiment downtick on that one. But with that, we're slipping in a very short break. Don't go anywhere. Well, the big story that corporate India is tracking at this point of time is what's happening with Go First and the voluntary insolvency petition that they filed in NCLT. Yesterday it was heard, but the order was reserved. In fact, in more developments, operational creditors are looking to submit a different petition to seek insolvency of the company now. Ankur is joining us with the latest details on this story. Ankur.
Yes, in an interesting turn of development, what we have learned is that the operational creditors are moving NCLT with a separate petition. Remember, there is already a petition which was moved by Go First themselves for initiating insolvency proceedings and granting moratorium on which the court has not passed the order yet. In fact, the order is reserved after the hearings which happened on Thursday. Now it will be interesting that why operational creditors are moving a separate petition. As per section 9 of IBC, any of the operational creditors which has not recovered the dues earlier by the different means can move a separate petition at tribunal, and after that insolvency proceedings can be initiated against that company. Now, as far as the names of these operational creditors are concerned, these are SS Associate Service, Air Castle Island. All these operational creditors have already decided that they will move a petition on Monday. That is when the court opens, because on Friday the court is closed on account of holiday. As far as the total debt of operational creditors is concerned, it is around rupees 3,800 crore, and overall the company owes around 11,000 crore, which includes 6,521 crore from financial creditors.
Right. Okay. In the meantime, two-wheeler manufacturer Hero MotoCorp on Thursday managed to beat the street estimates by reporting a 35% jump on a year-on-year basis in its net profit. This was significantly higher than what the street was penciling in. Let me take it across to Harsh and do all the number crunching.
Yes, so we've seen Hero Moto revenue jump a solid 12% year on year. It's come in at 8,307 odd crore. We're looking at EBITDA though, which was the most impressive figure. EBITDA actually expanded a solid 31% year on year, a 17% sequential jump in EBITDA. We're seeing that EBITDA number come in at 1,080 crore, and we're seeing margins expand solidly from the 11.2% mark same time last year to 13%, 11.5%. In Q3 as well. So we're seeing a good expansion in terms of margins. That's largely on the back of inventorization. So we've seen RM costs come in slightly lower than expected. And that's what's really leading the beat on the margin front. We're seeing PAT therefore go up 37% year on year, 21% sequentially. We're also looking at management commentary quite solid coming through. We have Niranjan Gupta, who's the CEO, who suggested that they were able to drive margin expansion and profitable growth this quarter through judicious combination of pricing, savings and mix. In terms of what brokerages are saying, we're seeing Macquarie maintain their neutral stand on Hero Moto, target price of 2640. They believe that the margin surprise was a beat, and they believe that increased competitive intensity poses earnings risk.
It was about Hero MotoCorp definitely going to be in focus today, but can't say the same about United Breweries. The margin performance was very dismal. The margin came down to 3%, and going forward as well, the management commentary does not really point to any improvement in the margin in a big way, because they believe that inflationary pressures are likely to continue. Let's get more details from Lisa, who's joining us. Lisa, hi.
Hi, United Breweries will definitely be in focus, and that is not just on the weak performance but also weak commentary coming in from the management. Well, we can simply say that the king of good times is not having a good run as far as the performance is concerned. Well, talking about the revenue saw a growth of around 3.5%, and that was led by volume growth, which also saw a 3% volume growth, and that was led by the premium category. Volume growth saw a modest run owing to the high competition, and also owing to some operating changes that happened in Tamil Nadu as well as Andhra Pradesh. Well, what saw a steep fall was EBITDA, which saw a fall of nearly 79%, and the margin also was impacted. Margin stood at around 3% versus 15% last year, and gross margin was at a multi-year low at around 38.6%. Well, this was on the back of inflationary pressure in both barley as well as elevated glass prices, and what the management is saying that this will continue for some time. So, well, the con call is expected at 4 p.m. today, and the key commentary to watch out from the con call is the pace of margin recovery, the sustained volume guidance, and also the market share position. They must have suffered some losses owing to the weak numbers, and also how long the high cost inventory will impact the margin, and of course the FY24 guidance. But for now, owing to the weak set of numbers, United Breweries, that may see a negative reaction in today's trading session.
Right, we'll leave it at that. In the meantime, let's also focus on What were the key takeaways from Aavas Finance's con call? Remember, the Q4 has been the first quarter completed under the Aavas 3.0 framework. Vamakshi is here with the highlights. Vamakshi?
Well, yes, yesterday Aavas Financiers was under pressure after it was announced that the company's MD had resigned from his position. And after that, in the con call, they actually came out with a clarification. They said that the former MD has stepped down due to personal reasons. However, they also clarified that promoters have not sold any shares since 2021 and they do not have any plans to sell in the coming year as well. Apart from that, when we look at the Q4 numbers, they believe that this is the first quarter completed under the new Aavas 3.0 framework, and in fact this has been the strongest ever quarter for the company. They disbursed nearly 1,581 crores in Q4, and this is an uptick of almost 23% on a year-on-year basis, and in fact is the highest ever disbursement for the company. They have guided for an AUM growth of anywhere between 20 to 25% for the coming year, and they believe that in the steady state spreads are expected to be at around 5%. Operating expense ratios are also expected to moderate going ahead, so another positive coming there. They also believe that by FY25 the product mix will include almost 70% of home loans, and in fact we did see that the RBI hiked its repo rate by 250 basis points during FY23, and Aavas on the other hand increased its prime lending rate by 160 basis points. They are expecting to further increase the rate by 40 basis points with effect from today. Aavas is well placed to continue its healthy industry leading asset quality as well, and that is what the management has highlighted. So largely those were important takeaways that have come in from Aavas Financiers.
Thanks, Vamakshi, for that. But for Tata Power, the revenue was broadly flat year on year. But remember, that was largely factored in because Mundra had shutdowns on account of the Section 11, confusions whether the other discoms would be able to pay that money or not. So we had seen that Section 11 implementation and Mundra was shut on account of that. That's why there is a bit of optical weakness as far as number is concerned. But I believe that was largely factored in. Going forward, the management's commentary regarding capex of 12,000 crore, deleveraging the balance sheet further as well as overall demand momentum was quite positive, and they are hopeful of getting a resolution regarding the Mundra supplementary PPA real soon. Listen into what the management had to tell us.
You all are aware, India's power demand continues to be very robust. In fact, the power demand grew by nearly 7% in Q4 and more than 9% in the whole year of FY23. Thermal generation also increased by nearly 8%, and renewable generation went up by 18% compared to the previous year. Under the Section 11, the context in which it is done is that you will get whatever is the actual cost that you incur on generating power, which includes the cost of coal as well as the operational cost. So it's basically a cost reimbursement mechanism which is there under Section 11. So that's how is the Section 11 where there would be no under recovery. As far as the under recovery post that, that's where the discussion is going on to see that how we come to an arrangement which becomes viable for everyone. And why do I say this is because Mundra is one of the most cost-efficient plants.
Okay, let's move back to the big contributors from yesterday, and they were clearly the financials as well as banks that held out. In fact, here's Hemang Jani telling us why is it that he likes M&M Finance.
Because of the pause that RBI has taken, we expect some improvement in the margins for many of these. So we do like the space. Our preferred picks over there are ICICI Bank, State Bank in the large universe, and within the smaller and mid-sized banks, we like IDFC First Bank. We think that also reported extremely good set of numbers, and there is a long runway of growth for IDFC First Bank. Clearly, apart from the large names that we covered, Mahindra Financial numbers were pretty good. In fact, the street was actually poised for some sort of a disappointment. But versus that backdrop, the company delivered very strong 14% kind of a growth in the earnings, and even the return on assets and return on equity was quite healthy. So we think that NBFC as a space is poised to do pretty well. In fact, we have done certain upgrades in our earning estimates for next year. And this is one of the high conviction buys for us with a price target of 320 rupees. Last, I think, 1.5 years, that transformation has played out extremely well. Now, if you look at the CASA ratio, it is 50%. And because of the confidence that is there in the deposit franchise, now the management is sounding extremely confident of driving this growth through other activities like commercial bank, credit card, home loan. So overall, we think that this bank can deliver a very strong growth over the next 2 to 3 years.
Okay, the HDFC twins are perched at 52-week high levels, but today there might be a bit of a dampener because the MSCI adjustment factor seems to have come in lower than what Street was expecting. Let's try and understand that news better, and Somit is joining us to explain us all of that. Somit.
Well, just to simplify the MSCI announcement that has come in now, post the merger of HDFC with HDFC Bank, the foreign investment headroom in the merged entity was expected to be considerably above the 15% level. Now, if the foreign investment headroom had been above the 15% level, then the adjustment factor for the MSCI inclusion would be at around 1 times. Now, though the foreign investment headroom would continue to remain above 15%, MSCI has come out with this notification where they're saying that they will include HDFC Bank in the large cap index, but the adjustment factor would continue to be at around 0.5 times. Now, earlier, as expectations was that the adjustment factor would have been around 1 times, there was expectations of foreign inflows of close to $3 billion US. But given the fact that it is not changing now, there could be some outflows of around 150 to 200 million US dollars in case of this merged entity. Now, why MSCI is not changing the adjustment factor? Now, they are not doing this to reduce the volatility. They are saying that if the foreign headroom again comes down below 15% in the next before the next review, they will have to reduce the adjustment factor, which could have led to excess volatility. And to reduce this or to avoid this excess volatility, as of now, they are not increasing the adjustment factor, but they will review again this adjustment factor ahead of the next MSCI review, and they'll continuously monitor this and would update their clients if there is any change regarding the adjustment factor of the merged entity that is HDFC with HDFC Bank.
Okay, Somit, we'll leave it at that. In fact, shortly we'll be joined by KK Mistry as well to talk about HDFC's quarterly performance. But Sandeep Sabharwal as well joins in on the show. Sandeep, hi, good morning. Just wanted to understand how much more headroom do you see for HDFC Bank, given how it's been an outperformer in the last 52 weeks?
See, overall, I think due to the merger process, there's been uncertainty, and that drove the underperformance. And now, as the merger is coming closer, we've seen these stocks perform. Overall, in a scenario where foreign funds flow are positive, we normally see HDFC Bank outperform. So that could continue for some more time.
Right. Okay, just looking at the performance of HDFC Bank, if we could just bring up not just yesterday's move where you saw a solid 2% gain on the stock price, but what the stock has also done in the last 52 weeks, wherein it's gained over 400 points. So a very steady go from HDFC Bank. HDFC as well will just come up for you on your screens, given the spike that you saw post the earnings on HDFC. In the last 52 weeks, of course, it's gained more than 700 points. And yesterday as well, this was a big mover. As was the entire financial pack, in fact, you know, everything from a Bajaj Finance to a Finserv, to Shriram Finance, Muthoot Finance, Chola Finance, these were all very, very steady and big movers in yesterday's session. In fact, some of the insurance companies as well made a very, very solid comeback too in yesterday's session. But let's now welcome on board KK Mistry, Vice Chairman and CEO at HDFC, to talk about their numbers. KK, let's start off with your NII growth. You know, the growth has clearly managed to surpass market expectations. Is it fair to infer that to a certain extent asset repricing could have led to this? And could you highlight the extent to which the portfolio has been repriced?
See, let me explain to you. You know, when our funding costs is based on external benchmarks. Our lending rates are determined by a prime lending rate, what we call a retail prime lending rate. Now, the retail prime lending rate reverses, increases, decreases, whatever it is, generally in line with the policy rates. So when policy rates increase, the retail lending rate will also increase. Policy rates reduce, the retail lending rate will also reduce. But in reality, what happens is that the contract which we have with individual customers specifies that the change in interest will only be effective at the end of or over a period of 3 months. So if you've taken a loan, let's say on 1st January, then your loan gets repriced on 1st January, 1st April, 1st July, 1st October. If you had taken the loan in February, similarly, it will be February, May, and whatever, every 3 months. So whilst the borrowing impact is immediate because all borrowing is linked to external benchmark, the increase in lending rates only comes over an average period of, let's say, 1.5 months. Everything gets repriced on an average in 1.5 months. So there is that lag, which is transmission lag, as we call it, between lending rates and borrowing rates. And in the previous calls also, we specifically said that when there is a sharp increase in the policy rates, the immediate transmission on the lending side is not seen. The transmission will come over 1.5 months period. So we've not seen any rate hike recently, and therefore the full benefit now of the rate hikes is now in the system. So from here onwards, logically, the spread should be more or less stable. So spreads have remained stable at 2.29. Net interest margin has actually moved up. Our net interest margin last year was 3.5%. This year it stands at 3.6%.
3 consecutive quarters of a 20% AUM growth. Would you say that the things was slightly softer in Q3 and Q4, and what is the expectation for FY24?
I would say my sense is that you would see a strong growth in the year ahead. On a standalone basis, as HDFC is today with our existing distribution machinery, we would expect the mid-teens to slightly higher teens kind of a growth even next year. But when you move into a banking structure, because of the much larger distribution framework, the much larger distribution platform of the bank, the massive amount of under-penetration of housing loans amongst the bank customers, logically one would expect the growth numbers to be strong. Now, when you compare first quarter and fourth quarter, there's a bit of an anomaly because the first quarter of last year had the COVID impact. So you saw higher growth in that first quarter as a consequence of the fact that in April, May of 2021, there was an impact of the second wave of COVID. Whereas when you look at the third and the fourth quarter, even in the third and fourth quarter of 2021 calendar year, there was complete normalcy in the economy and there was no COVID impact.
Mr. Mistry, the merger between HDFC and HDFC Bank is expected to be completed by July 2023. But could you talk to us what kind of changes or rejigs are you expecting? Because this morning as well, we understand MSCI is talking about a bit of a change in the adjustment factor.
No, we will be compliant with whatever RBI requires us to do, whether it's in terms of what they've suggested as far as HDFC Life, HDFC General Insurance, or HDFC Credila is. As far as HDFC Credila is concerned, we will get into a discussion with the central bank and see whether it is possible. If the intention is to sell and if there is, culmination of a deal theoretically before 30th June, and the regulatory and because of regulatory requirements, there is a delay beyond 30th June, then to seek permission to continue to onboard new customers. But otherwise, the structure would remain the same. These subsidiaries, instead of being subsidiaries of HDFC Limited, will now become subsidiaries of HDFC Bank. Also, the foreign free float available in HDFC Bank for determining the MSCI and the other indexes would be roughly about the foreign shareholding room which is available would be roughly about 18.1 or 18.2% as of last Friday.
Okay, that's the word coming in from Keki Mistry. Keki, thank you so much, as always, for taking the time out and speaking with us today at ET Now. Just looking at the market construct yesterday, of course, while you had Adani Enterprises as well, actually, which was a big beat in terms of their numbers, that sprung up very smartly. We've been talking about financials and how they led up higher. There was, of course, Manappuram, there was M&M Finance, Chola Finance, which were the star performers from within the broader end of the market. And then, of course, there was ABB as well, reacting to its very, very strong numbers. That also shot up a good 5.25% in trade. But let me quickly take it across to Anisha and Nikunj and talk about the stocks that you need to keep on your radar this morning.
Well, Aisha, apart from the result reactions that you talked about, there's one sector which has been chugging along very, very smartly, and that's the entire railway stocks as well. So let's start with talking about that. And RVNL is the poster boy, Nikunj, wherein we have seen a surge of 70% in 1 month itself. Is it the case of rising tide taking everything higher, or is there a structural story here as well?
Anisha, look, the surge in some of these stocks has been extraordinary. Now, there is definitely a lot of merit in saying that if there is one government pocket where the capex cycle is going to be a multi-year capex cycle apart from defense, I think it's railways. There is absolute merit in assuming that these tiny toons now are going to be some of the big names. They are no longer tiny toons now. They've become almost teenager size now, but they would be big companies. But the surge in last 1 month is not coinciding with anything which has become so dramatic or anything in terms of on-ground reality which has changed. What has changed, I guess, is that the markets are now running out of options where they can really find some value and long-term stories. My challenge with some of the railway stocks is that while the long-term picture and everything I think is important, and the capacity utilization, the bent of the companies, everything is moving in the right direction. But these are long cycle capex, which is that you get ordered today and you will be executing in 2 to 3 years. And FY24 and FY25 may not see that kind of an incremental benefit, which means that while the big picture argument for some of the railway stocks is absolutely intact, but you got to ask yourself is that how much of that is in the price. When you're an investor, the only thing that matters is at what price you're buying. And I think right now the price in some of the railway stocks is not that great. Now, why are we bringing out some of the delivery-based averages here? That's largely because the day trader now is very active and the delivery-based buying is slipping. So volumes are rising, delivery is falling, and the day trading has started picking up. For me, that's always if not a red light, but it is always a yellow light.
Yeah, always an amber light that there's a lot of that trading activity rather than the investment and long-term bets that people take. So that was about the railway stocks. But the other one that we want to talk about is also Dabur. The numbers yesterday looked optically very weak because the margin performance was not that impressive, and commentary on the con call was also a bit mixed. They are talking about rural recovery, but that inflation is going to create a problem for them.
So I think the way I see the Dabur stock moving is a near-term underperformance, which will give you time to accumulate. Some of these businesses are cyclical businesses, but they're structural businesses. The structural businesses go through cyclical downturn. You should always invest in a good structural business when the cycle is on the lower side. So when these great businesses, they go through temporary disruption, that's the time to buy. Will the rural economy be in a much better shape if you have a good monsoon this year? The answer to that is a firm yes. Are pressures, coming down in terms of the commodity pricing? The answer to that is yes. Have they gained market share? Of course, yes. Now, because they've missed the EPS by such a yardstick, brokerages would be forced because, ultimately analysts are slave to numbers. When your assumptions are changed, they will have to change the forward-looking assumption. So that adjustment will have an impact on the stock in the short term. But if there is a big fall, if there is a markdown because adjustment, if there is a sell-off because of the markdowns, what analysts have done, I've got a Macquarie report, EPS cut. I've got a Morgan Stanley report, EPS miss. Nobody's saying any good thing, right? And that's the time you buy some of these great companies.
That's the time you go contrarian and buy. So Dabur perhaps is a good structural story. Maybe a one-quarter blip, but maybe...
Sabharwal is a large holding in it.
Let's ask him that then. Sandeep, what's your take as far as Dabur is concerned?
I think I have nothing to add beyond what Nikunj said.
You and me have agreed. It's rare. It is very rare that you and me agree. Yeah. I think we're making it a habit now. So let's agree that you will be in the studio also.
Yeah, so we agree to disagree.
See, back to square one. But Dabur, Sandeep, if it falls, you'll buy?
Yeah, so Dabur, the results were results were sort of expected, but I think they missed on the bottom line because one, they did a significant amount of new promotions, and that's what I thought when the results came out, because volume growth has been so subdued for many companies that they'll need to push sales in order to maintain market share so that they are ready whenever the upturn comes, so they are ready for growth. And that's what I think Dabur seems to have done. So because there was a miss, so we could see some period of, like you were mentioning, consolidation or correction, and that could give an opportunity for new buyers, because overall Dabur is a very good company with very strong brands, and their success rate in launching new products and brands and making them a success is actually much higher than many of the other companies. So I think that's how I'll see it. No near-term triggers for the stock to move up. So whoever needs to buy, they can do it very slowly over the next few weeks.
Right. Okay, just looking at what Dabur was in yesterday's trading session, and for now, you've only got a 2% weightage in terms of sell calls on Dabur. Maybe more will trickle in today. But Sandeep, the other thing we were talking about is to how there is a clear divergence, at least in the last 52 weeks, in how Hero MotoCorp has performed and what TVS Motors has done. TVS Motors clearly has been the star performer of the year gone by, but this time around, in the last quarter, you've seen a complete reversal in terms of how their earnings performance has been. For Hero MotoCorp, very strong operational numbers driven by lower raw material costs. There were no negative surprises in the numbers, and TVS is an exact contrast. You think it's time to make that switch out of TVS to Hero?
So it's possible that we could see outperformance from Hero MotoCorp from after a very significant period of underperformance. If you see Hero MotoCorp not only vis-a-vis TVS but also vis-a-vis Bajaj Auto, it's been a big underperformer, and the earning beat yesterday was quite significant. So there's a possibility of mean reversion happening, and for that to sustain, obviously they'll need to keep on performing. The issue with the Hero MotoCorp management has been that they have been giving very aggressive comments on growth and etc. for a series of quarters when all the other companies were a bit cautious and actually not delivering. So this is the first time they have been actually able to deliver an earning beat, and it's a very under-owned segment of the market also, and as a stock also. So I think there is some upside in Hero MotoCorp.
But Sandeep, fundamentally, there is a challenge in terms of what strategy they've adopted. They are not big on EV. They've not really managed to do anything special. They've got a great distribution network. I'm surprised that Hero MotoCorp, which has ruled the two-wheeler market, I mean, they have been the Sartaj of the two-wheeler market. Have they lost their mojo? Has the company lost its mojo?
Yeah, so they've been slower to adapt. So we've seen this in the past also, that there was a time when Bajaj Auto, many years back, I think most of the analysts won't even know, when Bajaj Auto, when motorcycles started taking over the scooters market, Bajaj Auto was in complete denial. They said, we will not go into motorcycles, we'll just be in scooters. And they suffered a lot. Then they revamped their strategy, and then they came back very strongly. Whether Hero MotoCorp can do that or not, that's something we need to see, because they have lacked the product innovation which TVS as well as Bajaj Auto has done in the past. So they have been happy to just make money out of their cash cows in terms of the entry-level bike segment. So they are yet to establish themselves in the higher CC, more premium bike segments, even after so many years. So the jury is still out on that.
Okay, I also wanted to get a take from the chartists on a couple of these stocks. Naresh, Federal Bank as well as Tata Motors. Federal Banks, the numbers are today, and the market setup suggests that there has been a bit of a long build up there, and Tata Motors will be focused on account of that dividend consideration that they're talking about. Naresh? Okay, in the meantime.
Yeah.
Sure, Naresh, the question was on Tata Motors and Federal Bank.
So Federal Bank has been one of the best performing small cap banking names. The stock is above its 2018 highs. A base has been done at 125. A short-term breakout already done. A triangle breakout above 135. Setting up first for a move towards 150, 160 into a new all-time high. Clear-cut outperformer over the long term as well as in the short term. So short-term breakout done, positive on Federal Bank, buy at current levels as well as on dips. Tata Motors is a stock which has given a long-term breakout after 1.5 years of consolidation. The last big gap was at 450, which would act as a support. So going forward, it still remains a buy in this band of 460 to 480. the stop loss at 450 and a potential to go back into 52-week highs and almost all-time highs also in the medium term. So I have a target price of 540, 550 in the short to medium term for Tata Motors, buy at current levels as well as on dips.
480 rupees for Tata Motors. So Sandeep, if Mahindra and Mahindra was the stock of 2022, can Hero MotoCorp and Tata Motors be the stock of 2023?
The Hero MotoCorp is tough to say, Nikunj, I'd say frankly, because the volume growth picture is still very hazy. So because they have done well operationally in terms of the operating margin picture, but their new product as well as volume picture is still hazy. So I'm not very sure on that. But Tata Motors, obviously, we have seen from analysts from being ultra bullish to turn cautious, and now some analysts are bullish, but then the target prices are so near current prices that if there is an actual turnaround, then the price will move much higher. So the probability that Tata Motors does something very good is also great, and M&M overall, I think, should also do
well. I'm going to shift gears and go back to what we were discussing. Sandeep, the railway space is throbbing in terms of activity, government orders, the vibrancy in terms of management. But stock markets are also giving some of these railway stocks a re-rating, and these stocks are at a multi-year high. Do you think the excitement in the railway stocks, whether it is Titagar or RVNL, is a bit stretched now?
In long cycles, that will always happen, that the valuations will get stretched because the market cap of these companies is so small and the floating stock is so low, even now, that small amount of, and these days in the age of technology, the buzz goes around so much that even if a lot of retail investors buy even small quantities of these stocks, that adds up to a big move. So that will always keep on happening. But for some companies, the growth paradigm has completely changed from what it was. And to that extent, whether that's completely factored into the stock prices for long term, I don't think so. So I think longer term, they'll still do well. The pace of up move obviously has to moderate.
Okay, so that was about the railway stocks, but a couple of other names also. United Breweries and Blue Star will be in focus on account of the earnings. Kunal, your take, is there a trade in any of these names, United Breweries as well as Blue Star?
So United Breweries, nothing exciting on the charts. I think the stock largely has been very, very sideways. In fact, if you look at the last 1 month, last 2 months rather, the month of March, the stock started off going into a correction at 1500 levels, fell down to I think 1350, 1340, and it's now back towards, I think it just came back towards 1480 mark, and it's now back towards 1430 levels, which means net the stock has done nothing in the last 2 months. The price trends have been negative over the last 6-7 months as well for United Breweries. So nothing exciting in terms of the charts. We'll have to wait out for a confirmation that once the stock breaks past above 1500 levels, that's where maybe some trends could emerge positive for the stock. Blue Star also, on the other hand, the stock is actually showing signs of fatigue at higher levels. The last 2 months, it's actually made a double top kind of a formation just about that 1500 plus mark, 1550 plus mark for itself. So again, even though the volumes have increased high in the last 3-4 days, but the fact that even after such strong volumes, the stock has been unable to break past above the previous major highs of 1550 gives an indication that this is more of distribution which is happening. So again, wait out for confirmation that the stock probably have bottomed out or showing signs of breakout above the 1550 mark.
Kunal, a couple of other counters that our team helpfully pointed out that they're seeing a bit of a breakout were names like General Insurance as well as New India Assurance. Both of these counters were up 15 to 20% yesterday. Would you as well concur and say that there is a breakout happening on these?
Well, yeah, there is a strong breakout happening into both of these stocks. And in fact, I would definitely be looking to add these names. Now, it's always important to try and size your positions when stocks move up higher by 10-15% on average. All of a sudden, those could be start of strong trends for the stock price. But on the other hand, there could be a chance that maybe from a short-term angle, these stocks could probably come back into an overbought territory. So we have to be positioned accordingly. My sense is that both these stocks are exhibiting classical cup and handle breakouts on the weekly, monthly time frame charts. They have not yet given confirmation of a breakout on the upside, which means potentially a move of another 15-20% higher from current levels, and that's where you will see much more stronger breakouts happening for these stocks. So it's not that after yesterday's price up move, there is a feeling of left out for the stock price. I would still believe that buying these stocks at current levels and maybe on dips could be actually a good strategy before the bigger breakout happens on the monthly charts for both GIC RE as well as New India Insurance.
About 5 minutes to go, and then the pre-open rates will kick in. I mean, frankly, if you ask me, LIC has been a bit of a bummer this year. The numbers, they continue to disappoint. What was attractive, what was cheap has become cheaper. That's LIC for you. I mean, everyone's got it wrong. 20% down this year. Yes. Insurance for 5 lakh plus, it has been changed in the budget, but that's not like death and hell, because LIC has little representation in that category, so to speak. In fact, private players have a much larger representation in that space. That's LIC for you this year, down 20%, and I think the IPO was 700. I think 650, 700. I don't remember, but it's been a disappointment one. Sandeep, when the LIC issue was not going through, everyone said, "Oh, what reform process? Government is not able to take LIC public." They took LIC public. Everyone said, okay, they're doing the right thing. It's a reform in the right direction, and they priced it very nicely, and a lot is left on the table. But now, when the stock has fallen, the same folks are saying, why have they taken LIC public? They should have not taken LIC public. It has only destroyed shareholder value. It should have been with government. A non-listed avatar was much better. Decide kar lo bhai.
Like when it was not listed, then the question of destroying shareholder wealth was not there because it was not listed. But I think the problem with LIC is continuously losing market share in more profitable segments, which the sort of like in the case of public sector banks where the move has been relatively slower, they are not attracting the new generation sort of, or people high earners of the new generation, etc. So I think that's a challenge which will remain. So it's not going to go away. So I don't see any big story. So I think it will become like one of those PSU companies which always flatters to deceive. So they'll be in between, they'll be trading rallies, but that's about it.
552 rupees. That's LIC for you. Where is SGX? Let's look at SGX. Are we in for a good Friday? When you have a market like this, nobody actually wants that, oh, why Monday was off and why it's Friday and 2 days will be off again. Because when the weekend happens, you lose momentum, right, Kunal, sometimes?
Yeah.
Nobody wants a Friday this time.
But Kunal likes truncated weeks.
No, the market actually likes truncated week. In fact, the last 4 weeks when there was a truncated week, we've actually performed very well on the indices, both on the Nifty and Bank Nifty.
The next one is in July now.
And the 1 week when the markets
next one is July.
When the 1 week the markets actually had full week, we were actually negative.
So now we have only full weeks till July. Let me check when the next bank holiday. Just hang on. Sometimes
I think it's in June end. There is June.
So Kunal is saying that now no good weeks will come. No, I'm serious.
No, that was on a lighter note, of course.
Sandeep, you buy this argument or this theory?
No, it depends. Stock market there are 2 less holidays. Today there is a bank holiday because of Buddha Purnima. Stock markets are not shut.
What amazes me is that we trade on 1st of Jan. Even Bangladesh is first shut on 1st of Jan. And we are the 3rd or the 4th largest stock market in the world. What globalization are we talking about? 1st of Jan is technically a chutti for everybody. Even Bangladesh does not. Look at Japan and US.
I think leave aside globalization. I think we have just one holiday for Diwali, which is the most ridiculous thing.
That I always.
So you can carry on the campaign plate.
Yes. Will you be part of it?
Yeah,
we'll start with you. Nuresh is not participating. Right, Nuresh?
Nuresh wants to mint money every single day and he wants the trading session to be on. Is that the case, Nuresh?
And I would prefer a much longer holiday, something like an 8-day holiday in China.
Oh, the way the Chinese
and look
have
at the irony, our ticker head Cheryl has just flashed currency market shut today.
It's almost like teasing us that you guys are working, currency market is
She
not.
just flashed it on purpose. Has she done on purpose? Ask her. Yes.
Okay, we get the joke is on us totally today. But at least it's Friday and the weekend is coming. That's something to write home about. And for now, the SGX Nifty is suggesting that it's going to be a mild start. 18,200 is at least where the Nifty is at this point of time in the pre-open. Just first rates trickling in, so not much to make of it. We'll have to wait for the rates to settle. A bit of a decline of around 50 points, but given the surge that we saw in the last hour of the trading session, Nikunj, this is par for the course, right? A bit of a sideways move, but the momentum continues on the upside.
You know, the FOMO crowd has just kicked in. And this time the FOMO crowd is the elite FIIs. The elite FIIs have just come back. You look at where the positioning of the market is, and that's the point. Let's look at the YTD data and the month data in terms of how strong the reversal is in terms of foreign institutional investors. They've been forced to come back. All of them went to China. India is expensive. China is cheap. Go to China. Kya hua? You've come back. Look at the month-to-date chart on a net basis. February, March. This is the YTD total, right? I would imagine, right, Patricia? So net, they are still down 40,000 crores this year, which means a lot has to be covered up. So the so-called China fans have to now come back because they've not made money in China.
Yeah.
If you've not made money in China, you'll be forced to come back. So China has been called like a boogeyman. So they've gone there and now they'll be forced to come back because even at low levels, they've gone there and they've lost money. So that I think is a serious reversal which is about to happen. Sandeep Sabharwal, are you still there? You logged out.
Yeah, I'm there.
Would you agree with this theory that this China bogeyman has been called now? That everybody went to China, even at low levels, they lost more money. They'll be forced to make a comeback, and this time the FOMO is with not us, it is with the FIs.
Yeah, the foreign funds have to return. See, China was an obnoxiously cheap story at the bottom because those stocks went to low single-digit valuation. So some amount of money reallocation was fine. But then China is no longer a big growth story. Despite all their efforts, the Chinese growth is sputtering. They are hardly able to revive their economy. And that's going to be the reality. So I think this China versus India argument is not going to play out. And to that extent, India will be on a higher growth trajectory and as such attract more risk money, both in terms of the growth prospects as well as the overall structure or the shareholder protection structure which is there in India, which doesn't exist in China so much. I think that's going to play out. Today, I think there's some news on this MSCI, HDFC weightage, etc. So I think that could also play on the sentiments in Indian markets today.
Okay, Sandeep, we'll let you go on that note. Thank you so much for joining us. Pre-opening rates are just settling in. Just wanted to highlight a few stocks which are likely to see a bit of reaction when they open. HDFC Twins, they were sitting at 52-week high levels, but as Sandeep also pointed out, the news regarding the MSCI adjustment factor might point to a bit of an outflow on the merged entity, and that's why you might see a bit of a negative reaction on those two counters. Manappuram Finance continues to be in news on account of that ED searches, so that stock too is likely to open with a bit of a downtick. And then you have some other result reactions to track. Blue Star, which is showing that it's going to be higher. CEAT as well as one more stock, as well as TVS Motor and Hero Motocorps. So some of the stocks that you need to have on our radar this morning as well. But what are the stocks which are on radar of our chartists? Nuresh, what are the top recommendations coming in this morning?
So that would be a buy on Container Corporation. We've seen one by one a lot of PSCs do well. This is a stock which corrected from 850 levels to 600. Given a 3 to 4 month range breakout yesterday. So that's a short-term trade with a stop loss at 620 and a target price of 700.
What's on your list?
Well, that'll be a buy on the paint stocks. So Berger Paints is something which I would recommend as a buy, trading at 620 levels, clear towards a breakout about the 620 odd mark. So would suggest a buy 660 as a near-term target, stop loss at 600.
Okay, the SGX Nifty, or rather the Nifty pre-open rates, they're settling in 0.5% or so lower, but let's see which way the market heads. Remember, yesterday as well was a mildly negative start, and from there we managed to scale it up higher all the way to the session highs. So fingers crossed really on that. But let's also tell you what else is making headlines. And Apple's first quarterly results topped estimates, largely led by stronger than expected iPhone sales. Now, the iPhone revenue, which makes up more than half of their total revenues, rose to $51.3 billion versus an estimate of $48.84 billion. The tech giant also boosted its dividend and announced a $90 billion share buyback program. An influential workers' union at South Korean electronics maker Samsung has warned that members could walk out over wage disputes. Now, this could be the first time, or rather first strike ever in the company's history. The National Samsung Electronics Union claims that the management has cut the union out of wage negotiations. And also joining the many companies axing jobs, Swedish car maker Volvo has now said that it will eliminate as many as 1,300 jobs as the company ramps up cost-cutting measures. Management flags off that economic headwinds, increased raw material prices and increased competition as areas of challenge for the industry. And US President Joe Biden has congratulated Ajay Banga on becoming the World Bank president, the new one at that. In a tweet, he said, and I quote here, "I look forward to working with Ajay in his new role and to supporting his effort to transform the World Bank to reduce poverty and address challenges including climate," end of quote. And back home, dairy major Mother Dairy has slashed the MRP of its edible oil sold under the Dhara brand by 15 to 20 rupees per litre. The decision to cut prices comes amid reduction in global edible oil prices. The move also in line with the Food Ministry's directions asking retailers to cut prices.
Well, back home, amid worsening conditions in violence-stricken Manipur, the state government has authorized all district magistrates to issue shoot-at-sight orders in extreme cases. The order comes a day after clashes broke out in several areas during a protest march against the demand for inclusion of the state's tribal community in the scheduled tribe category. Well, from Anne Hathaway to Alia Bhatt, the Met Gala in New York saw a slew of celebs strutting their stuff in sweeping gowns and snazzy suits. Charathala, a small village in Kerala, produced this lauded carpet for the stars. The eye-catching carpet, created locally by Net by Extra Weave, a business owned by the third generation of a family that has been producing floor coverings in Kerala for more than over a century, was woven using natural fibers. 70 days of arduous labor resulted in the completion of this carpet construction. And in the most awaited music concert for the country, Backstreet Boys marked their return to India after 13 years at Jio World Gardens in BKC. In attendance, many B-Town celebs from the likes of Shraddha Kapoor, Jacqueline Fernandez, a nearly 2-hour gig kick-started by their top track, I Wanna Be With You, with crowds singing and swaying along. Next up, Delhi now prepares to groove to the Backstreet Boys today. And royal fans have started camping outside the Buckingham Palace, the residence of the new monarch. A few people have been camping there for about a week now to catch the best spot to view the coronation process.